The first primary accounting function is measurement. We want to measure and record all business transactions that impact the accounting equation. We can break this measurement process down into 6 easy steps. Let's use an example to work our way through these steps. Assume you work for a photography store and have purchased some additional cameras to sell in the store. You haven't paid for them yet, and they cost a total of $5,000. Step 1. Use source documents to identify accounts affected by a transaction. You place the order for those cameras. Your source documents would be your invoice or bill from the place you purchased the cameras. Source documents give us needed information about the transaction, such as what you bought, when you bought it, and how much it was. We can also determine what accounts are involved in the transaction. Accounts are just a record of activities related to specific items. What happened in our transaction? We bought some cameras for our store, and we've not yet paid for them. What items were involved? The cameras, and the fact that we owe someone money. So, the accounts that are involved would be inventory and accounts payable. In accounting, every transaction involves at least 2 accounts. It could involve many accounts, but it will always have at least 2. Step 2. Analyze the impact of the transaction on the accounting equation. The reason every transaction has at least 2 accounts impacted is that we must always keep the accounting equation in balance. Our transaction involved the cameras, inventory, and owing someone money, accounts payable. What types of accounts are these? Inventory is something we own that we hope to sell. Something we own. This sounds like an asset. Accounts payable is an account to keep up with money we owe a vendor or supplier. Something we owe. This sounds like a liability. So, the impact on the accounting equation is that an asset and a liability are changing. How are they changing? Is the asset increasing or decreasing? Did we get additional inventory or get rid of inventory? We got more cameras, so inventory is increasing, which means assets are increasing on the accounting equation. How about accounts payable? Do we owe someone more money or less? We owe more. We haven't paid for the cameras yet. So, accounts payable needs to increase to show the additional money we owe, which means liabilities would be increasing on the accounting equation. Assets increase by $5,000, the amount of the cameras, and liabilities increase by $5,000. The accounting equation is still in balance. Bravo! Step 3. Assess whether the transaction requires a debit or a credit to the account. Now we get to the nitty-gritty of recording accounting equations. Debits and credits are how we translate increases and decreases in accounts. This topic needs a little more time, so hang on and we'll circle back to this soon. For now, just trust me that to increase an asset, we will need to debit it, and to increase a liability, we will need to credit it. No worries, I'll explain fully later. Step 4. Record the transaction in the journal. Once we know what is debited and what is credited, we can record the transaction. Up until this point, it has been analysis, but nothing's been recorded yet. We want to record this transaction and show all accounts that are impacted. We do this by making what is called a journal entry. The journal is a record. Think of it as a sheet of paper or a spreadsheet where we list all the transactions for a company. Each transaction shows all the accounts impacted by that transaction, and each transaction balances. All the debits equal all the credits. Again, don't get confused by debits and credits. We'll deal with those in a bit. For our example, our journal entry would look like this. Inventory would be debited $5,000. Accounts payable would be credited $5,000. Debits are always on the left and credits are always on the right. Notice that the total of our debits are the same as the total of our credits for this journal entry. Step 5. Post the transaction to the ledger. We've recorded the transaction. Hooray! But we haven't updated the total or balance in the inventory or the accounts payable account until we do something called posting. Posting is taking the journal entry from the journal and updating the individual accounts in that entry. The details of each account are found in the ledger. This is a record of each account, its increases and decreases, and its balance. Imagine a notebook, and each page of the notebook has a different title at the top: cash, inventory, supplies, accounts payable, and so on. Each of these represents a different account, and on each page we have details about each account. We see how much we had to start with in each account. We see when the accounts increased and decreased, and we see the ending balance in each account. We take our journal entry we made in the journal and update each account in that entry in our ledger. For our example, we would turn to the page titled Inventory and record an increase in that account of $5,000 and update the balance in that account. We would then turn to the page titled Accounts Payable and record an increase in the account of $5,000 and update the balance in that account. Now we have posted the entry and updated all impacted accounts. We're in balance and all up to date. Step 6. Prepare a trial balance. Once we've recorded all the transactions for a period of time in the journal, could be for a month, a quarter, a year, and we've posted those transactions to the ledger, updating each account, we might want to see what our ending balances are in all of our accounts. We could flip through the ledger and look at each ending balance of each account. However, this could be time-consuming, and we probably don't want to give the ledger to everyone that may need or want the same information. Therefore, we can make up a report called a trial balance. This report simply lists all the accounts we have and their ending balances. An easy way to see all our balances on one piece of paper. Hooray! You've done it! You've completed all 6 steps of measuring a transaction.